Hello, everyone, and welcome to the Inside ETFs weekly webinar, 3 Ways to Protect Your Portfolio from the Next Pullback. My name is Saveda, and I'm the Director of Conference Content here at Inside ETFs, and your host for today's webinar. Recent market volatility reminded all of us that markets don't just go up in a straight line. While markets have since recovered, we know that there is more volatility ahead. In today's webinar, we look at 3 ways to protect your portfolio from the next pullback. We're fortunate in the ETF space to have a huge amount of research and development going into these defensive strategies, and we are thrilled today to have 3 true ETF thought leaders talk about their strategies. Mebe Faber is a co-founder and the Chief Investment Officer of Cambria Investment Management. He is the manager of the Cambria's ETF separate accounts and private investment funds. Mr. Faber has authored numerous white papers and 5 books. He is a frequent speaker and writer on investment strategies and has been featured in Barron's, New York Times, and the New Yorker. Jack Gilligan is Director of Research at ClearRock Capital. He started his investment career with Goldman Sachs in Chicago and spent 5 years on the equity and sales and trading desk. As Director of Research for ClearRock, Jack understands that his work lays the foundation for the sound investment strategies ClearRock offers clients. He considers it a good day when I help give our clients peace of mind. David Verratti is Director of Research for Blue Sky Asset Management Quantax Funds, where he has been since 2014. Previously, Mr. Verratti served as the Vice President of Economic Research and the Strategic Development at Flexible Plan Investments. Prior to this, he was employed at Macquarie Private Wealth Management as a Quantitative Director for Butler, Philbrick, and Bordillo, where he was the co-developer of the Darwin Portfolio Management Strategy. The format today is straightforward. Meb, Jack, and David are going to give 5 minutes to present, they're going to get 5 minutes to present their strategies to us, and then we're going to engage in a brief Q&A about the role of defensive strategies in a portfolio. As a participant in this webinar, you are more than welcome to ask questions to the presenters using the Q&A toggle on your webinar viewing browser. But before we get Meb, Jack, and David, we have a special treat. Mark Thomas, Senior Vice President for Systematic Strategies and ETFs at Hartford Funds, is going to join us for a special Fund of the Week segment, where we reckon one fund that we consider especially interesting or important for investors in today's markets. Mark?
Yes, hello.
Hi. You are... We will give it to you to take away.
Great. Thank you very much. Thanks for tuning in, everyone. I appreciate the time. I want to introduce a strategy today. RODM is the name of the ticker of the ETF, and it's particularly fitting for the conversation overall today because as we think about defense in the portfolio, we certainly need to think about offense at the same time. And RODM is just such a strategy that could offer that potential. So before I jump into the details of the strategy that drives this ETF, I do want to set a little bit of context, which is always important to consider. If we look at where we've been, the next 2 slides really talk about the U.S. leadership. Is it going to continue? That's a constant conversation. It's certainly one that's relevant in the overall conversation today as we enter all this market volatility. And as we look back, just I'll call your attention to the column at right, the 10-year average return for U.S. equities. You can see that they've really dominated returns overall for the last 10 years since post-recovery of the global financial crisis. Down at the bottom there you see Japan, international equities writ large, emerging markets, and Europe all being dwarfed in terms of returns relative to U.S. equities. So with that as backdrop, I think a lot of investors are really wondering where to allocate next. And certainly international equities is a place that many investors are already looking. One other point to make here is the cyclicality of these returns. U.S. equities have outperformed international equities consistently for almost the last 7 years. Those cycles, looks like it may be waning, may not be, but it is important to note that they're not all working in the same tandem. So if you think about Europe in particular, Japan, they are lagging in the recovery cycle. Their valuations are potentially more attractive than the U.S. equities, and in our view, there is more fertile opportunity for long-term growth. So with that as backdrop, RODM, Hartford Multi-Factor Developed Markets ETF, it really seeks three things. It's playing offense and defense. First, we're trying to enhance return potential through the multi-factor stock selection. We're trying to improve diversification, and by improved diversification, we're going deeper into the developed markets equities to find the companies that have enhanced return potential. And we're also trying to lower volatility. This strategy targets up to 15% less volatility than the cap-weighted universe. So let's look at how we accomplish this. The slide you're looking at here speaks to how we play offense within this strategy. The stock selection process, as I mentioned, is multi-factor. We're looking for a combination of factors in every company that we invest in. A good valuation. We're looking for a good quality company selling at a good valuation and that is also working in the marketplace as evidenced by positive momentum. And the portfolio overall, as of December 31st, has 83% of its holdings are actually exhibiting those positive factors, whereas the cap-weighted benchmark is 50%. So you can see the stock selection process at work here. One of the beautiful things about the ETF package is you can see every day what the holdings are, and you can analyze. You can pull an X-ray here and see what the conditions are for future growth. If you believe that high-quality companies selling at good valuations with positive momentum give you a better chance for return potential, then this portfolio offers that. Let's look quickly at performance. Performance is not just a factor of the selection process and the more favorable risk-return premium that we're trying to select based on. We're also reducing volatility. So as I mentioned at the outset, there's an explicit target of 15% volatility reduction in this core strategy, and it's delivered exactly that. This ETF is actually 2 weeks away from its 3-year anniversary, and you're looking at the volatility reduction of about 14% over that period of time, a very, very live representation of the strategy. And then from a performance basis, it has outperformed nearly 300 basis points per year with that volatility reduction. So you're getting good risk-adjusted return overall. So the question that we're all asking is our portfolio positioned for the future, whether that's a future of more volatility, higher returns, and in what market? I think it's always important to consider the overall allocation of a portfolio. This slide is just a reminder that portfolios can get out of whack for a variety of reasons. 2008, you had a 65-35 allocation, U.S. to international. That's pretty far out of whack today. I'm certain that most advisors have kept up with this and been reallocating along the way. But it does illustrate a point that often international equities lag their appropriate allocation. And one of the reasons for that is investors' concern maybe about higher risk, more volatility outside of the U.S. And again, RODM, with its volatility reduction objectives, may be a good solution for that. So I'll close with a quick summary. RODM, enhanced return potential through multi-factor stock selection, improved diversification, and up to 15% lower volatility over the course of a market cycle. With that, I thank you for your time.
Thank you, Mark. To find out more about Mark's fund, I encourage you to visit their website at hartfordfunds.com and head over to the ETF Hub. It's an absolute great resource. Now let's turn to the second part of our webinar, 3 approaches to protecting your portfolio from downside risk. We've pulled together 3 of our favorite downside fund providers, and we're going to give them each 5 minutes to present their ideas. While you're listening to these presentations, don't forget to send in your questions using the Q&A toggle at the bottom of your screen. We'll ask them at the end of our presentation. First up, today is Meb Faber. Meb is a co-founder and the Chief Investment Officer of Cambria Investment Management. Meb, the deck is yours.
Great, thanks, you guys. It's great to be here. I'm going to whir through this pretty fast, but you can always find more information on Cambria Investments or Cambria Funds. The topic of today's tail risk ETF is written a lot of research we published in a white paper that was the better part of last summer I spent on called Worried About the Market. It Might Be Time for This Strategy that came out, I believe, last fall. And so a real quick overview of kind of the way we think about tail risk research. We'll talk briefly about why we think it's particularly useful right now, the current market environment, why we decided to launch in the past year, traditional defensive strategies, and then ours specifically. So first, look, we all know, I think it's pretty well accepted at this point, that valuations are stretched. We don't think it's a bubble in the U.S., but we do think the U.S. is one of the most expensive in the world, with future returns somewhere in the 1% to 3% nominal over the next decade. And on top of valuations, you also find, this is often the case, but sentiment is stretched. Here's one type of sentiment survey. This goes back to the 1960s. This is from Luthold Group research that shows, in general, when things are very bubbly and everyone's bullish, future returns for stocks in the next year are pretty low. In this case, the top 10, the average return is 0, whereas when expectations are really low and people are bearish, future returns are pretty high. And 2017 came in as the second highest reading ever. This was the average across the entire year. So not a great sign for equities, and volatility is low. Maybe except for a week ago when things started to return back to normal. 2017 was a pretty big outlier. It was the first market year in history where every single month was up for U.S. stocks. And then for where if we finished up this month, which doesn't look like we will, it'd be the longest streak of up months in history. So you have this low volatility environment, which is not traditionally normal. So what can you do? You know, we often say when you want to hedge a risk, there's some steps you take first. The first one is, if there's a risk, just don't take it in the first place. If you have 100% of your portfolio in U.S. stocks, maybe on 90, maybe on 80. Cash is a perfectly reasonable investment. Second, diversify. Foreign markets are much cheaper. Foreign developed, with foreign emerging being cheaper still. And the cheapest bucket, which is actually what our largest fund does, ETF, that picks the cheapest equity markets in the world, is a good choice. Diversifying, obviously, that's investment 101 in bonds, in real assets. For those who know us long enough, know we love trend following strategies. And then only then do you really start to think about tail risk as a strategy at that point. So what do we do? In kind of the way we think about it, it's super simple. The whole point and the way we designed this, we wanted to be the simplest possible fund for very low fee. It's 0.59%. So all the fund does is, with 90% of the assets, it buys 10-year U.S. government bonds. And with the remainder each month, it buys a ladder of puts. And so the range is around 3 months on out to 16. They're out of the money, usually 5 to 10%, ballpark, closer to 10 usually. And then each month it'll roll the closest option into the farthest dated, which is usually around that 12 to 16 month period. Super basic. And the question we always get is on the sort of expectations. You know, I think for this fund, obviously we can't guarantee it, but what we're targeting is if the S&P was to go down 20% next month, we would roughly expect this fund to go up 20%. You know, you can't guarantee that, of course, but that's our somewhat approximate target on the downside. And obviously it depends on volatility and all that good stuff. And one of the thoughts for the advisors on the call was that, you know, a lot of people don't think about this, and we wrote a few articles on this, where if you're an advisor, it actually potentially makes even more sense to use tail risk hedging, because you have stock in your own personal portfolio, you have clients owning stocks. So when the bear market comes and it's down 50%, your fee revenue goes down 50%. And also clients behave poorly in a bear market. And lastly, if you're not an independent RIA, but rather work for a wirehouse or someone else, you might get fired. So these are all reasons to think about hedging stock market risk as almost like a commodity, like a airline would hedge gasoline, or a cereal company would hedge prices of wheat. So I'm going to wind it down, kick it over to the rest of the presenters, and stick around for Q&A in a few minutes. Thanks, guys.
Thank you, Meb. Up next, we have Jack. Jack?
Great. Thank you very much. Jack Gilligan, Director of Research from ClearRock Capital. We're a RIA based in Idaho and California. We just celebrated our 10-year anniversary this past summer. We started the firm on a foundation of believing in ETFs as an incredible vehicle to be able to create asset allocation portfolios for our clients. We have, I think, a pretty good background and been doing this for a long time, and we've continued to hone and change and evolve our process in our portfolios over time. So we actually just completed a rebalance yesterday. So I thought it was pretty timely and interesting just to talk about a few things that went into that rebalance, how we approached it, and what some of the results were on it, and how the changing environment over the past couple of weeks while we were in the midst of this, helped sort of impact our decision making and how we dealt with that. So from the top, one of our beliefs as a firm is, discipline is really key, and creating a disciplined, repeatable process over time, trying to remove that emotions from investing. We manage money for high net worth individuals, foundations and nonprofit endowments. Most of our clients want to take the long-term view, and that fits really well with our investment philosophy. So when you start to see some of the noise that, really happened in the markets over the past few weeks here, we definitely hear the noise, but you have to put it in context of, what our view is from a long-term basis, what our goals are, and, what are the fundamentals really telling us there. So, the current noise, it's not something, people like to say, oh, ignore the noise. You can't ignore the noise. The noise is new information. This current noise, right, we're in the middle of shifting from fiscal tightening and monetary stimulus to fiscal stimulus and monetary tightening. So we've reached this inflection point as bond yields have started to go higher. So obviously it's telling you something that's new information, but how do you handle that? And our process is to kind of go back to the basics. Okay, what are the fundamentals telling us? As part of our process, one of the things that we developed, I think about 6 or 7 years ago, we developed an economic dashboard. So, we've always taken that macro view. There's a lot of really good data that can tell us where we're at in the business cycle out there. How do we put it into a tool that's a bit more useful than just kind of anecdotally knowing where some of the data is? So we created this dashboard in a diffusion index that tells us and gives us a reading on the economy in the business cycle. So here's just a snapshot, our one at the end of January. I think there's kind of 21, 22 different factors that go into this. You can see the reading on a diffusion index, right? 50 is neutral, anything below is contracting, anything above is expanding. We're at 75 at the end of January. Business has been strong, consumer strong, employment number was great. But what this tells us is the market is having some near-term correction, but the economic fundamentals are still really good. And the business cycle, we believe, is still intact. So, what does that mean to put it in context of the rebalance we just did? So, the discipline involves rebalancing. The last one we did was about 9 months ago or so. Doing a rebalance is something very systemic. It's an opportunity to sell your winners and buy your losers as well among your asset classes. And we also look at it as an opportunity to make some tactical changes to the positions within each asset class. So here you can see a snapshot of this is just one of our strategies, our diversified conservative growth strategy. You can see bonds, had come down to about 45%. We have a target of 50. Domestic equities had continued to grow, and our other asset classes down the line. Here's after the rebalance that we just completed. So fixed income, we bring back up to our target of 50%. Domestic equities, we trimmed back down a little bit. We added to foreign. Emerging markets were basically the same, and we added a little bit to commodities. And last thing, we built up dividends, cash on our clients, in our clients' accounts from dividends being paid, and we redeploy that cash. So, that rebalance, we had a few goals in key things that we were trying to accomplish and changes that we made. So, as I mentioned, we moved back towards our asset class targets. We reduced equities, added fixed income. We added some foreign and emerging markets. Importantly in fixed income, and that's where it really kind of came in, is we made a lot of changes below the surface. So we've been pretty short duration. The 10-year obviously came way down the middle of last year, started moving back up, and then was pretty static in Q4. And then we've seen the 10-year do nothing but go higher here since the first of the year. So a few things that we did: we had a position in preferreds that we sold down. We trimmed some of our exposure to high yield, and then we added to our floating rate positions as well as to tips. Elsewhere, we did sell a little bit of our gold position, which gold did pretty well last year relative to other commodities, and we did add some more diversifying commodities in PDBC. And lastly, we had a position in aerospace defense, ITA, that we bought over a year and a half ago and had a 60+% return opportunity to take profits there. So one of the key factors and things under the surface, as I was mentioning in fixed income, is we worked pretty closely with BlackRock. Obviously owns iShares since our beginning. They've been a great partner to us developed different tools to help RIAs and ETF managers like ourselves when we're making changes to our portfolio. So one of the key things that they did, they have a product called Aladdin, which is their big risk analytics software. And we worked with them to run our portfolios, our current portfolio and our proposed portfolio through their software. They also have some new tools they've been introducing that are publicly available on their website as well that uses some of that power of Aladdin. So anybody can go kind of check that out and run their portfolios through there. But the key was, your intuition and your intentions might be targeting one thing. Ours, in this case, was to reduce some of our exposure to inflation and lower duration and reduce some exposure to rising rates. Our initial first cut of that, our intuition was in one direction, but when we really kind of got into it, we were looking to maybe add some more mortgage-backed securities, but that ended up looking, once we kind of dug into position by position, not too much like our benchmark. We're looking within tips. Oh, do I need to wrap up?
Yeah. Sorry. Yes, we're going to ask you to wrap up there.
Okay. Anyways, just to wrap it up real quick, to really kind of figure out what our goals were and how to tie it all together. So, anyways, I'm happy to answer more in the Q&A, and that was my last slide.
Perfect. Thank you so much, Jack. And wrapping us up, we're going to have David Vardy. David is Director of Research for Blue Sky Asset Management, Quantac Funds. David?
Thank you very much. So a bit about us. Blue Sky began as a separate account manager. We're an RIA based in Greenwood Village, Colorado. And we began to design risk-managed portfolios for clients. The demand was the result of people wanting more robust solutions that could reduce drawdowns during bear markets like in the early 2000s and more recently in 2008. Our research showed that you're much more likely to meet your financial planning objectives if you can manage the risk of these large losses. And so after we learned about the limitations and constraints of the separate account structure, we launched the Quantac funds to deliver the components of the strategies in a more transparent and tax-efficient manner. So a bit about our investment philosophy. Our investment philosophy is unique because we don't believe in traditional modern portfolio theory. Instead, we believe that asset allocation needs to be dynamic and shift as economic conditions change. Market history is filled with examples where secular market regimes have changed dramatically, and a traditional strategic asset allocation can be very vulnerable depending on how it's constructed. So for example, we had a low interest rate regime for nearly 40 years, so if rates start to rise, what has worked well in the past may no longer work very well. By having the ability to go on offense or defense and also overweighting different asset classes that are more favorable as a function of market conditions, we believe that this can provide a more consistent return profile over time. And lastly, to take the emotions out of the equation, we use a rules-based quantitative approach to constructing our portfolios. This allows us to be disciplined and timely with our decisions. So mainly I'm going to talk about why people need risk management. And so why do you need to manage risk? I mean, capital preservation is the primary reason. A loss hurts a lot more than a gain. If you lose 50%, you need to make 100% to make your money back. And losses of this size can certainly happen in bear markets. So if we can cut the drawdowns in half or even less, it will be much easier and also faster for investors to recover. And considering that we're in the 9th year of a bull market, one of the longest in history, we believe that this is a material risk that people need to be prepared for. You can't time risk management. I think a lot of people like to say, okay, well, I'm going to buy risk managed funds when I think the market is going down. No, the purpose of having risk managed strategies or funds is so that they're already there, so that you don't have to actually make that decision. And so by the time the market goes down, it's either too late or emotions tend to get the best of people. The second reason why you want to have risk managed strategies is for capital appreciation. And this is a little known reason, but basically what risk managed strategies allow you to do is that they take the position of diversification and fixed income in terms of trying to provide a buffer to the portfolio. So instead of managing risk by holding more fixed income, what you can do is you can increase your equity exposure, and therefore you can actually increase returns. And in this environment where interest rates could be rising, this could be very significant. So we believe that capital appreciation is another benefit for risk managed strategies. So our ETFs tend to cover the different types of objectives that investors would have, whether it's growth, income, total return, or real return. And by putting things in an ETF format, it tends to be much, much more tax efficient. And so that's why the ETFs have an advantage over other types of strategies. Now, in terms of the different stages that investors are at, there are two basic stages. And basically, the accumulation stage is the stage at which people are trying to accumulate money for their retirement. And what you find is that the ability to shift the exposure to hold more equity risk is beneficial during the accumulation stage. And also, it takes out the risk. You don't need to necessarily dollar cost average. By having the risk management in there, you have the ability to make a lump sum payment and be able to invest right away. And so even if you're an aggressive investor, risk management is still beneficial. In the decumulation stage, that's where you're withdrawing from your account. And when you're withdrawing from your account, volatility is the enemy of during the decumulation stage. And so having a risk managed strategy, if you start retirement when you're just before 2008, all of a sudden, if you're trying to withdraw a fixed amount from your portfolio and you have a material drawdown, it can significantly change your financial plans. And so having a risk managed strategy in place is a great way to reduce that risk. So now I'm going to talk about what kind of risk can be managed versus what kind of risk can't be managed. And that's an important distinction. Just because you're a risk manager doesn't mean that you can manage every different type of risk. And so different types of risk managed strategies have different types of benefits. And so the types of risks that we believe that we can manage are recessions. Recessions are longer term. They take months to years. Examples, the tech wreck in 2000 to 2002. A credit shock, such as the credit crisis in 2008. Again, a lot of these things take months to years to develop. And also secular shifts in inflation and deflation. And while we're starting to see some of the early signs of potential inflation, we're still broadly in a somewhat deflationary or stable inflationary environment. And so when we look at a secular trend in inflation or deflation, you need to be able to shift your asset allocation to adapt to that as well. The things that you can't protect against are market microstructure and liquidity risk. And the recent correction is a great example of that. You saw a lot of derivatives-based strategies that were tied to the VIX happen to do quite poorly. And a lot of these market shocks, they create a lot of dislocations with liquidity, and they literally come out of nowhere, and you have no chance to really react to them. Geopolitical and terrorism type events, those are self-explanatory. You can't predict those. And also unexpected monetary policy moves. And we saw a little bit of that where the recent Fed had quite a different stance from Yellen, obviously who just recently came in. And so again, a lot of these, and when they do make monetary policy decisions, if it's unexpected by the market, it can have a significant consequence, and it's not really predictable. So we deal in risks that are predictable over longer periods of time. And so
I'm going to ask you to wrap it up as well.
Sure. I think we're good.
Perfect. Well, thank you so much. As a reminder, you can ask questions of Meb, Jack, or David using the Q&A toggle at the bottom of your viewing screen. Right now, we are going to do a bit of a Q&A. So let's get started. Gentlemen, and I'm going to start with Meb. Where do these strategies fit into investor portfolios?
I think it varies per investor, and this is a very philosophical question. One of the most is that it, for us, is a bond substitute. Some people it's an alternative. Some people it's a diversifier. But for us, for many ways, it's not a great investment. But it's one that if it keeps you in the game longer and it helps the whole portfolio, it's a great choice.
Jack, your thoughts on that?
Yeah, for our strategies, we really look at them as, the core part of our clients' portfolios, and, we'll evaluate other, types of whatever other goals our clients are trying to meet. We may look at other strategies to kind of supplement and complement that, but our portfolios are really very based to be a core part of our clients' investment assets.
David, same for you. Your thoughts on that one?
Yeah, I think it's really highly dependent on the client and what the client's needs are and what stage they are in their financial planning cycle.
How liquid are these strategies? Jack, we'll start with you.
Our strategies are 100% ETFs, and we do a screen on all the ETFs that we purchase in our portfolios. And one of the big factors is liquidity, both in the underlying as well as being able to trade ETFs. So ours are very liquid.
David?
Yes, I mean we typically also hold. We do have liquidity screens. We tend to hold most of the more liquid ETFs. And that tends to form the core or the higher weightings within our portfolios.
And Meb?
Yeah, ditto. I mean, we're government bonds and trade options on the S&P, so the most liquid option market in the world. The fund's small, $10 to $20 million range, but we think it has quite a bit of capacity.
One of the questions from the audience is your ticker symbols for these ETFs. So, David, I'll let you start with that one if you want to just present your ticker symbol out there, and then we can go.
Just so QXGG is our Quantex Risk Managed Growth. We have actually 5 of them. In terms of risk managed ones, it's just QXGG is our Quantex Risk Managed Growth. QXTR is our Quantex Risk Managed Total Return. QXMI is our Quantex Multi-Asset Income. And QXRR is our Quantex Real Return, Risk Managed Real Return.
Jack, same question for you.
Our clients are all separately managed accounts, so we invest directly in our clients' accounts, so we don't have a ETF wrapper to access our strategies. We work direct with the clients.
Okay. And Meb?
We got 11 ETFs, but the one we're talking about today is TAIL, TAIL, the easy one.
Well, gentlemen, that's all our time for today. Thank you so much, Meb, Jack, and David, for your time and insight today. Thanks to Mark Thomas and Hartford Funds for supporting today's webinar. And thanks to you, our listeners, for taking time out of your busy day to think about these critical investment ideas with us. Join us again next week for how to bring an entirely new generation of investors into the markets. How do you convince millennials and Gen Z that investing is important? Thank you again, and see you next week.
Thanks, guys.
Thanks a lot.